Hello and welcome to Fireside Chats on Nomura Podcast. I'm your host, Jordan Rochester from the Global Markets Research Team, and today is Wednesday the 3rd of June. In this episode of the Fireside, I'll be talking to Robert Subbaraman, the head of Global Macro Research and co-head of Global Markets Research, on his work on the topic of COVID-19 and its impact on the global economy. I want to specify the team have worked on something that's pretty interesting. It's a visualizing tool looking at the risk of a second wave of COVID-19 to come. I'll also be asking Rob about the spread of unconventional monetary policies in emerging markets, which economies in his mind stand out as the underperformers, and then, of course, the visual tool that you can find on nomuraconnects.com. But first, Rob, I want to bring you in here and talk more broadly about the series of pieces that you and the team have published over the recent weeks. Some of those have had pretty strong conclusions just from their titles alone, such as Asia's job markets are hanging on by a thread, or the coming crash in Asian exports. Now, given the loosening of lockdowns, Rob, are we not in the recovery phase? And given the bigger picture, what is your view on global growth from here?
Good questions, Jordan. I think it's right that the big advanced economies have reached bottom in May or April. China maybe a bit earlier. But it's been such a sudden collapse in growth. I mean, that's a defining feature of this crisis. It's how sudden it's been, that I think it's going to be a bounce back. And we're starting to see that in the survey data, the mobility data, and that's partly driven by pent-up demand. And we're seeing that clearly in China now, and I think it will show up more in stronger data, sequential data in US, Europe. But that said, it's not going to be all smooth sailing. There'll be a bounce back with the pent-up demand, but then I think it's going to get more challenging.
You say bounce back, Rob. We have the sort of shapes that we can talk about when it comes to global growth. There's V, which is very sharp bounce back. There's U, which is a bit longer. There's even L. And then it goes even further. Some folks even talk about a double dip, which is W. Let's simplify it down to the sort of shapes here. Global growth over the next year or two, Rob, which shape is it for you?
I actually like a jagged Nike swoosh sign as my shape.
That is a good shape.
It is one. I think the reasons are why, even though it might start to look like a V in the coming weeks and maybe month, after that, it's going to get a bit more challenging. So I'll give you some reasons. One is the economies are starting in a very fragile shape right now, and we are going to have a big hit to exports because all economies have weakened. In Asia, for instance, we think exports are going to be down 20% in Q2. There's also this risk of a second wave, right? Especially with economies fragile. And the third thing that's thrown in there now is geopolitics. We're seeing a lot of unrest in the US, but also China-US tensions are on the rise again with Hong Kong stuck in the middle. So I think I would classify it more as a Nike swoosh sign.
Okay, rather than a swoosh sign, I look at the markets, Rob, especially equity markets, and you can just draw V's all day long. Why is it, in your view, that there's this disconnect between what the outlook is versus what the markets are saying it is?
Yeah, a lot of people bring this up. And I think the asset markets, which certainly look like a V, are justified in that. One reason is if you look at what policymakers are doing and their predicament, they're looking at it from a risk management perspective. And I would say the risks are very asymmetric. They're largely on the downside. I talked about some of them earlier. And so they need to set policies that are trying to minimize that downside risk. And that means that monetary and fiscal policies are going to be extremely loose for an extremely long period of time. And I think that's really heartened markets. But the other thing is, I would say there's a lot of young traders now. And if you think about it, ever since the global financial crisis over 10 years ago, there's been policy puts. Uh, Government central banks have always bailed out markets when there's been downturns. And I think investors have got used to that. And we're going through that process again. This is probably the mother of all policy puts. But I think that's another reason why we've got a V shape in the markets.
And Rob, do you think that that sort of stimulus from those central bankers and policymakers, do you think that will continue throughout the rest of this year?
I think so. I think the risk is it's going to get even bigger in the coming months. Europe is looking like it's going to step up with more stimulus, monetary and fiscal, some this week. But I think the key thing, Jordan, is it's not going away for a very long time. Uh, Central banks are so far away from their inflation targets. Uh, Growth is so far below potential still. Unemployment is so high, and all the downside risks. So, we're in a long period, I think, of very easy money.
Okay, Rob. Well, now I want to bring it on to the main topic, which is your sort of new tool, which is detecting the risk of a second wave of COVID-19, but also how to track its impact on the economy. Now, you brought this piece of research out recently. The team yourself developed it. It's a visual tool. Now, we're on a podcast, so we can only describe what the charts look like. But can you explain a little how this tool works for what you aim for it to do?
Sure, Jordan. Yeah, I'll have to be a bit creative here, given it's all words and no visual. But I think one of the number one concerns for markets is a second wave, right? If you go back to the Spanish flu over a century ago, it was the second wave that was much more deadly than the first wave. And so we've created this visual tool, and let me describe it a little bit. The first component is a mobility index that we've developed based on the Google Map data. And essentially, it's like a diffusion index where we look at the difference between people mobility around the workplace and people mobility around residential places. So think of it like mobility around CBDs versus residential suburbs. And so what happened during the extreme of the lockdowns was our mobility index was very negative. And it meant people were basically staying at home and just moving around close to their residence and very little action around the central business districts. It was like the readings were like at their worst around minus 100 to minus 120 in the worst situations during Italy's peak coronavirus, Spain, France, but also other smaller countries like Israel and Singapore had very little mobility around workplaces. They were all below minus 100. The US was around minus 70. The other extreme, a country which had very little sign of a lockdown, was South Korea. Its worst mobility was around minus 40. But now economies are opening up and mobility is increasing as lockdowns relax. So those negative numbers are starting to become less negative. And so what we've done is we plot our mobility index against the cumulative number of COVID-19 cases. So if you imagine a graph, it's a scatter plot. On the y-axis is the mobility index. And on the x-axis is the number of COVID cases. And so the way it works, Jordan, is if you move more vertically north, if the line starts to move more vertically north, it's good news. It means lockdowns relaxing, economies are reopening, and there's no signs of a second wave. On the other hand, if the line starts to move up as lockdowns relax, but then starts to shift to the right, so it starts to maybe move northeast or even east, that's a sign of second waves. Lockdowns getting relaxed, people getting more mobile, but then you're starting to see COVID cases pick up again. And that could even cause the line to go down again, maybe even east or even southeast as COVID cases pick up and mobility gets constrained again.
What's really useful about it, Rob, is it looks like your typical V shape in the good scenario. And in your bad scenario, it's an L shape. Is that how you would describe it?
Yeah, very simply, that's the exactly right way to describe it. And so V shape, it's all going well. Uh, Reopening's on track. L shape, the opposite. And so what we've done, Jordan, is we've applied this visual tool to 45 countries. And the interesting thing is there's big divergences starting to show up in terms of how well economies are doing the reopening. Uh, and so if we look at it for the 45 countries, we would say there's about 17 that are on track. That means that uh, economies reopening with no signs of really second waves. And a lot of those are in Europe. Some of the bigger ones are Italy, Spain, Switzerland, Ireland, um, but also some in Asia, such as Korea, Thailand, Australia. I should point out, though, that we don't have China in this analysis because Google, of course, doesn't have China data. Um, the next kind of category, I would say, which has 13 countries, is where there's some warning signs that got to watch out. It's possible that there could be second waves. Very tentative signs. So the lines are not going up vertically; they're slanted a bit, but not near an L. And they're countries like the US and UK right now. And then the final grouping of 15 countries are ones that are in the danger zone. The lines are still moving, as you said, L, moving horizontally to the east. And we find that they're mainly EM countries, where, to be honest, there's more of a challenge between saving lives versus saving livelihood. And the pressure to ease the lockdowns maybe too early is, I think, greater than in the advanced economies. So in this danger zone in particular, there's a lot of LATAM countries, but also India and South Africa.
So there's clearly some sort of divergent story here. It sounds like countries that essentially locked down earlier and in your sort of good outcome area, and the ones in the danger zone, the ones that locked down later on, and emerging markets at the end of it. So Rob, what's your take on the potential for the divergence in the recovery of emerging markets here, especially when it comes to this recovery?
I think it's huge, actually. So the first point I'd make is I think there's a deep divergence between DM and EM. I think the DM economies are recovering faster. EM economies are struggling. And to put it logically, they were among the last to be infected by COVID-19. But I think they're also really struggling to suppress the curves. And that's what our visual tool is showing up. Um, but also, I think it's going to get tougher going forward, Jordan. I think if I look particularly in EM, what is quite worrying is uh, not so much in Asia. I'd say China is doing well. Many of the uh, richer Northeast Asian countries like Korea, Taiwan are doing well. But other EMs are really worrying me. So many of the South American countries, but also South Africa, Turkey, India. These are the countries that worry me. And I think it's going to be very interesting on the policy front, I think.
So when we had the global financial crisis of 2008-09, it wasn't long, Rob, until just a year or two later we saw the makings of the euro area crisis. But every general is ready to fight the last war. Should we be looking somewhere in emerging markets for an underperformance story that you think isn't clear to markets yet, at least in current pricing?
Short answer is yes, I do think so, Jordan. And let me explain a little bit around this. So, um, what's happened, I think, in many of these big emerging markets outside China is um, they've had a massive hit to GDP. They were already fairly fragile going into this, so it's deep recessions, but uh, they've also had to expand policies very aggressively. So they have now uh, very large fiscal deficits and uh, piling on public debt. So their fundamentals have deteriorated. They're in deep recessions. But what is also striking is they're reverting to the DM approach of quantitative easing. So, in Brazil, in South Africa, in many of these emerging markets, central banks are starting to buy government bonds. In Indonesia, they're even buying buying government bonds in the primary bond market. And this makes sense in that they really need to keep the yield curve flat because there's so much massive government bond issuance that's starting to come through that if they don't do this, long-term interest rates will go up so sharply. So they're doing this. But I think the risk around all this QE is that investors are going to eventually say, we're not getting compensated for this rising risk premium of no growth, actually recession, and very weak fundamentals. So, Jordan, I do think EM is where there is significant risk of crises. I think the weak pressure point is exchange rates. I know they've depreciated quite a bit, but I think there's still a lot of room for them to depreciate further. And what also makes it doubly worrying for EM is I would say they're the biggest risk of having second waves. And so, going forward, this visual tool we have, which we do update daily now, we have a publication called Reopening Economies Alert, which has all the visual charts. I think it's worth watching EM because if this risk of a second wave gets bigger and bigger and they have to reimpose lockdowns, I think we could see big rating agency downgrades, a lot of capital flight, and as I said, big currency devaluations.
Okay, thanks, Rob.
Thanks, Jordan.
So those are the views from us, those are the trades from us, and that's the Fireside Chat with Rob. Thank you for listening into the podcast. If you enjoyed listening to the show or want to hear more from Nomura's economists, researchers, and investors, please like and subscribe to Nomura's podcast on Apple, Spotify, and SoundCloud, or wherever you do get your fill of podcasts. Also, please do log on to nomuraconnects.com to keep up to date and keep on listening. Thanks, goodbye for now, and stay safe.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, East and West.